As I discussed in my blog, where I have snapshots of my trades, my most serious and perplexing issue this year is what I'm going to do with the proceeds from maturing Treasury bills, CDs, and corporate bonds. I buy investment grade corporate bonds. I use a ladder approach in my fixed income investing. I have maturities occurring every week. In February, I will have to redeploy 92,000 in proceeds from maturing securities. My current inclination will be to redeploy most of those proceeds into Treasury bills purchased at auction. I am a conservative investor whose primary investment objectives are income generation and preservation of capital being important. I do take some risk to generate income, but have been reducing my allocation to stocks and stock funds as demonstrated in my post. Treasury bills currently do not have a credit risk. The interest rate risk in Treasury bills, which mature from 1 month to 1 year, was starting in 2022 when the Fed started to raise the federal funds rate, that interest rates would rise shortly after purchasing one, and the investor would be better off waiting a month to purchase a higher yielding Treasury bill. I call this type of interest rate risk the lost opportunity risk, and it basically relates to earning more income by waiting longer to buy. That is no longer the interest rate risk for a Treasury bill purchase, since the Fed is apparently done, for this cycle at least, in raising the federal funds rate. So the short-term Treasury bill purchases now are currently predicted to be as good as it gets for that type of investment as far as yield goes. The interest rate risk is that the Fed will start to lower the federal funds rate, with the first cut currently expected in May and no later than June of 2024, using the federal funds futures contracts. When and if that happens, proceeds received from maturing bills cannot be rolled over into bills that have the same yields, but only in progressively lower ones. That is a type of interest rate risk, and it is not a good result for me. I have dealt with this kind of interest rate risk issue with a bond ladder, particularly my long-term Tennessee municipal bonds and some investment grade corporate bonds that mature in 2025 through 2027. My bond ladder is, however, heavily weighted in 2024 maturities and to somewhat lesser extent maturities in 2025. For now, I can see receiving an acceptable return to me from short-term Treasury bills purchased at auction, so I can punt the what to do problem down the road some. I have already entered an order to buy the 3-month Treasury bill that will be auctioned tomorrow, Monday, February 5th, and will enter another order to buy the 4-month bill that will be auctioned on Wednesday. I'm hoping that corporate bonds will continue to rise in yield some as they did last Friday in response to the robust jobs report, that will allow me to lengthen the maturity term beyond Treasury bills and receive a higher yield. I discussed how to buy Treasury bills at auction in a prior video that I will link here. I used the 3 brokers to buy Treasury bills at auction, none of whom charge a commission. Those brokers are Vanguard, Schwab, and Fidelity. Most of the bills are being bought in my Schwab account now using proceeds from maturing securities that are swept into the Schwab sweep account that pays only 0.45%. I'm increasing my position in the Vanguard Federal Money Market Fund, which is the sweep account for that broker that currently pays about 5.3%, seeing no reason to use funds in that sweep account to buy Treasury bills. In order to buy at auction has to be placed before a certain time prior to the auction. Each broker has a different time. Most are around 9 o'clock or so Eastern Standard Time, but that needs to be checked. When non-competitive bids are placed through a broker, the par value is $1,000 per bond. So in order to buy 10 bonds would have a principal amount of $10,000 at maturity. The bonds will be sold at a discount to par value, and the difference between the price paid at auction and the par value is the interest.